Hello, everyone. Welcome to another episode of DST Essentials with K Properties. For many of you who have listened to our Friday conference calls, this is a series that we've been going through where we focus on a recurring structural theme aspect of the DST and 1031 exchange investment process. Today, I'm very excited to be joined by Tim Emanuel, one of our vice presidents here at K Properties.
Happy to be here.
And we're going to be digging into the zero coupon structure and investment strategy. This is a little bit more nuanced maybe than some of the other topics and DST structures that we go through in this conversation. But we really wanted to get the information out there because it can be a very powerful tool specifically for investors to utilize when they need to replace an above average amount of debt, which we'll get into a little bit later in the conversation. But just to kind of set a baseline or a foundation of understanding, Tim, if you could maybe just define what we mean by a zero coupon and talk a little bit about how these DSTs are structured.
Yeah, absolutely. The zero coupon DST sometimes doesn't really get a lot of attention. A lot of our investors actually, I think they get on our website and they probably scroll right over the offerings, not truly understanding what and why they are there. But they serve a very important purpose when you're completing a 1031 exchange and you need to handle some aspect of debt. The reason why we like them is because they provide a certain degree of diversification ability that we can insert right into a 1031 and hopefully help de-risk the investment portfolio that you're going into. So a zero coupon is defined as a DST that has a high leverage amount. And when I say high leverage amount, it's typically going to be somewhere between a 75 and 90% loan to value, okay? And the reason why that's important is because if we can replace your debt in a 1031 exchange with a efficient vehicle like this, then it takes less equity to secure the debt needed within your 1031. And what does that do? That frees up more equity that you could potentially be able to use on a debt-free DST, which inherently have a less amount of risk associated with them.
Mm-hmm. Yeah, and so conceptually, just for our listeners, these offerings, as Tim mentioned, 75 to 90% loan to value. So 75 to 90% of the total value of the DST offering is debt that the sponsor has gone out and fixed and structured into the offering.
That's right.
And the name zero coupon refers to the fact that these offerings don't pay any cash flow, right?
Exactly.
Because of the high leverage amount. Typically how these are set up is 100% of the rent that's being brought in from the property or properties in the DST is going to service the debt, both on the interest level, but also on the principal reduction level in certain cases too. So it's a little bit atypical in the sense that most what we'd call traditional DSTs project a certain amount of cash flow, right?
That's
immediately
right.
And throughout the course of the offering period. The zero coupon does not pay any cash flow.
Yep.
Once again, 100% of the revenue goes to service both interest and, in many cases, reduce the principal balance of the loan over the holding period. Tim, could you maybe describe a couple of examples of what zero coupon DSTs have looked like over the years? What are the typical types of properties that we see show up and maybe why?
Yeah, so there's some important things to talk about in regards to that too, because if you remember from, maybe talking to your K advisor, they probably told you that the average DST hold period is between 5 and 7 years. With a zero coupon, you are typically going to have a much longer hold term, okay? In fact, you're going to have a much longer lease. A lot of times the lease and the loan are going to run coterminous alongside each other. And those leases are going to typically, I would say, probably the golden area that most of the sponsor companies are looking to hit is probably a 20 to a 30-year hold even on these zero coupons. And the type of asset becomes very, very important because obviously, we have a pretty good idea of what type of market we're going into when we first make one of these investments, but none of us really knows what's coming 5, 10, 15 years down the road. So how do you feel good about going into a long-term investment that's typically securing a large amount of debt over a period of time that, a lot of folks might not even be alive by the time these things are done. And that's actually part of the estate planning benefits of a zero coupon as well. We could kind of touch on that maybe a little bit later, but I think it's important to understand that, looking at the actual tenant and who's in that property is paramount. And so what we're typically looking for is going to be something that is investment grade. You want a very, very large company. I want you to think about your FedExes, your Amazons, something of that scale, and not just a simple distribution center. We want something tied to a major ancillary asset piece. So I want you to think like a port, okay, or maybe even like an international airport, something that's on the tarmac. Or maybe a utility provider, like a large electrical company, might use the DST structure and put one of their buildings in it because it's not going anywhere. They're planning on providing a steady, recession-resistant service, and that's going to be your ideal asset. Another one that we've seen a lot of too is U.S. government buildings. There's no greater creditor than the U.S. government. In fact, I think it's somewhat humorous to say, but it's a good point to think about because when we think about risk, that's obviously the top tier as far as what safety is reflected in investments is having, the U.S. government back something, but it really is the only tenant that can actually print money. To pay its own bills, right? And like we've heard that before. It makes us smile, but it's the truth. And we've had really good luck, especially going through the due diligence on these. When you look at the actual asset and it's something so stable, so immovable, like a VA hospital or a very large new build government services building that also happens to have a security rating on it that makes it somewhat bomb resistant or bomb proof.
Right.
And those are some current examples, some recent examples of assets that we've seen tied to the DST coupon structure. And if you haven't gotten the picture already, I'm failing. But the whole idea is very strong tenant, very long-term lease with an asset that cannot be moved easily, where we can attach a large amount of debt with a very secure leasing contract and have faith that it's going to help secure this 1031 exchange over the long haul.
Absolutely. And I think another way to look at this is what type of property would a lender be willing to put up 75 to 90% of the value of the building? It's going to be a tenant of very high credit quality, a location that they view as mission critical.
Yep.
A property that has a long enough lease term where they could attach a debt structure that they feel comfortable because they are the largest participant in the deal.
Exactly.
They're the largest investor by an overwhelming majority. So hopefully that gives a little bit more understanding for our listeners in terms of the type of properties that we see attached to these zero coupon DSTs.
Yep.
So shifting gears a little bit, you touched on this in the intro a bit too, but can you talk in a little bit more detail about some of the advantages that the zero coupon structure provides, and then also some of the risk factors, like what could be some of the disadvantages that investors should be aware of too?
Yeah, I'll hit on the disadvantages first. I think those are the one you got to really consider. What's there, what could actually hurt this type of investment. So again, obviously, the first thing we're looking at is the strength of the lease terms and the strength of the tenant. Okay, and paying close attention to that because here's where a scenario where this could not be good. Let's say that very large corporation, for whatever reason, 10 years down the road shuts down. Then what? Well, we want that corporate backing of that lease over that long term to be able to protect the investors and protect the investment. And so that becomes absolutely paramount. If you look at commercial properties and if you look at DSTs or you look at any of these types of investments, one of the biggest risk factors is always the loan, and this has a lot on it. So we're going to take a deeper look too at how many loans are within this, because sometimes we might see more than one loan that's placed on the property. So we want to know what that looks like and what those terms are. The other risk factor, too, is the sponsor company, frankly. You want to go with a sponsor company or you want to look at a firm that has done these before and that has done them well. a lot of times because of the size of these contracts, in order to secure a contract this large, especially with the U.S. government or one of these large corporations, you generally are going to need to have a really good communication channel with that tenant, a good working relationship. And we have sponsor companies that have established themselves in this space that have the ability to put these offerings together in a stable, reliable, predictable way. So as far as risk factors go, yeah, I would put like the biggest thing there is, you don't want your tenant going dark. And if they do, you want to know what the backup plan is. And so I think looking at those as fundamental risk analysis measures that you're going to really take a look at carefully. And if you are not, familiar with going through the paperwork on it, which not many folks are, that's what we're here for.
Right.
We help break that down. We look at the due diligence side pretty closely. And we look at, and if we have questions about it, we're going to generally get those sponsor companies onto a phone call or a Zoom with us personally, with you, if you're interested in going into that too, and get the answers to make sure that we all feel good about it. But on the risk side, that I would say that pretty much highlights the bigger points. On the advantages side, the real advantage with the zero coupon is that if you have to replace debt with your 1031, it's really nice with the DST, right? You've probably all heard us talk about diversification, but to be able to pull that debt away from the rest of the equity and secure it on something, a U.S. government building or an Amazon distribution center, whatever it is, to secure that debt away allows you to then go back into the marketplace, reinvest in other DSTs or other properties, all cash, okay? And I think there's something to be said, especially in this market right now where, we have higher for longer interest rates. More folks are having to refinance their debt, and they're looking for solutions of how to stabilize it. And, I think if we look at the overall markets and what's going on right now across the country, a lot of us expected to see lower interest rates by now, and we just haven't, right? And so the folks that were putting off refinancing that loan or making the sale of that property because they wanted to figure out what their next step was going to look like with a 1031, what kind of loan terms they were going to be able to get, they're basically in the same position they were 2 years ago. And this is causing a lot of problems. And so the advantage with the zero coupon is you can remove that complication of debt permanently. You could take it right out of your 1031. You can put it off to the side. And then the remaining equity, of course, is going to go into something that has inherently less risk. You have the option of going into debt-free properties, which we've got plenty to pick from across different asset classes, and really open yourself up to growth without the added detriment of having a refinance or a debt issue down the road.
Yeah, I really like what you said there. And I think from my perspective to add to what you said, the zero coupon strategy allows investors to very efficiently soak up a significant amount of debt within the context of their 1031 exchange.
Yep.
Right? We work with investors that are approaching their 1031 exchange from all different leverage ratios.
Yep.
A lot of our investors have zero debt or a low debt percentage, but we also, come across investors who maybe they refinanced their property, a couple of years ago. They stripped a bunch of money out. Now they're looking to sell because they don't want to actively manage, but they have a 70% loan to value they need to replace, which we'll touch on that more in just a minute. To flip to the risk side, simply put, most of these zero coupon DSTs are single tenant net leases. Yes, they have strong credit, but we always caution investors about the reality of single tenant net leases combined with debt.
Absolutely.
And because you're starting out at a much higher loan to value than even what's available in the traditional DST range, that comes with additional risk.
Exactly.
So that is really something that we want to tease out in some of these conversations is the risk that the investor is taking on. Is it justified by what other opportunities get opened up as a result of them potentially tapping into the zero coupon strategy?
Absolutely.
So with that, I think maybe it'd be helpful to go through a few examples, right, of different scenarios of how we typically see investors utilize the zero coupon strategy within their diversified 1031 exchange portfolio.
Sure.
So could you maybe share a couple of the main instances or setups of how investors kind of enter the conversation on the zero coupons and how you've seen that play out in investors' portfolios?
Right. No, I think that's great to kind of revisit, and I can actually use a couple recent examples too. And I'll leave out names obviously and whatnot, but I had just recently had a situation where a client, kind of similar to what you had talked about, had owned a property for a long period of time. In 2021, 2022, when interest rates were low, took a lot of that money back, took out a loan on the property, and pushed their loan to value up. I would say they were in a situation where it was a commercial property, and their exit price was not as high as they had hoped. And so they did not have quite as much equity to work with, and they had approximately a 60% loan to value that they had to replace. So not a terrible situation whatsoever. But if you've looked at DSTs recently, you know that most of the loan to values on most DSTs are somewhere between 40 and usually 55, 56%. There's a few about, at the 60 range, but the zero coupon became an obvious answer to be able to help them out. They were also at the point where they saw the value in being as debt-free as possible, and it was a good-sized exchange, so the equity piece was very significant. And so when we ran the numbers on what was available, because we have the ability, because of the size of our portfolio, we're not just talking about, well, hey, you've got 2 or 3 options to handle debt. We've probably got 30 that are available that we can run different numbers on in different scenarios. And so when we kept running the scenarios, we kept coming down to the fact that because of where their loan to value was at, they were going to make more money on the projected distributions off the DSTs by utilizing a zero and going into debt-free properties. And so it became a very simple decision for them to ultimately diversify in such a way that the zero coupon was able to handle the debt piece, and then the rest of everything else was able to cash flow. And so that was one recent example where it really helped them out on a month-to-month basis, and also be able to de-risk the portfolio. But I would say too, it's not that if you have a debt component in your exchange that it all has to go into that zero coupon DST. Another strategy we've done recently too is maybe using the zero coupon DST to handle 50% of the debt or 60% of the debt, and then the rest of the debt diversify into maybe a multifamily or multi-tenant offering. Okay, so that way you have some diversity within the debt too. And so it really is a nice way to insert that in and be able to get the numbers where you need them, and also be able to really make sure that the equity piece is as protected as possible within the 1031.
Yeah, that's great. I had a similar situation with an investor years ago. They had an even lower loan to value. It was 25, 30%. And they really wanted to distance themselves as much as possible from the debt across their portfolio.
Yep.
So this individual took a small amount of his equity, went into a zero coupon, and then the overwhelming majority of the equity, went debt free.
Exactly.
So as a way for him to diversify and kind of offload the debt to and attach it to the one zero coupon strategy. Same concept, same idea that you worked with, just with an even lower amount from a loan to value standpoint. And I was actually talking to other investors today that they refinanced their property a couple of years ago when rates were really low. They sold they're selling the property, and they are exiting at about a 70% loan to value, right? Which is a little bit awkward in the DST world. As you talked about earlier, most of the traditional cash flowing DSTs, 40 to 50%, sometimes a little bit higher. And then your zero coupons are 75 to 90%.
Yep.
So with these investors, I was walking them through, if they didn't want to have to contribute additional cash to the equation to make the numbers work, they can allocate a portion of the equity they're expecting from their 1031 exchange to a zero coupon DST, say at an 85% loan to value, and then 2/3 of their equity into a DST at a 50% loan to value. Right. So they're diversifying. Majority of their equity is still going to your traditional like lower leverage cash flowing, DSTs. And then a segment of their cash or of their equity is going to the zero coupon, so that together they're replacing their 70% loan to value, they're reinvesting 100% of their equity, and they're fulfilling their full 1031 exchange requirement and deferring 100% of the taxes without having to individually qualify for a loan.
And that's the key point,
which is the key point, because a lot of investors may not be able to,
That's right.
especially if they're retired or their income has dropped or, other situations. The debt is fully non-recourse to them too, right? So they're not signing any, loan guarantees. Their equity is still at risk that they're contributing to that DST. And ultimately, it saves them from reaching into their back pocket and having to pull more money away from other liquid parts of their portfolio to make the numbers work and to avoid a substantial tax liability. So that's where the zero coupon can be really, really powerful, is it allows us to mix and match with different strategies, different debt structures to hone in on a specific 1031 exchange need with the minimal amount of cash required or minimal amount of cash out of pocket required.
No, I don't think you can really say enough too about the ease of which going into these investments has become, right? Because and again, I was just talking to another investor about a situation. They're in the Northeast, good sized transaction. It's like a $4 million transaction. And he was looking to purchase his own property, and he had about $2 million of debt that he had to take care of, so about a 50% loan to value altogether. And the hoops that this guy was jumping through to get pre-qualified to be able to go make his next 1031 caused a delay in his sale. It caused a delay in his upleg that he was about to the point where he was so frustrated, and after years of rolling properties over, learned what a DST was and ultimately learned how a zero coupon could really simplify his debt problem that he had been working with for a couple of decades. And to the fact that he could then go into something where the debt was prearranged, there was no qualification other than being an accredited investor, and being able to close within a matter of days, which put all of his plans back on track. And I think that's very powerful. I mean, life is short. Applying for loans is not the most fun thing that we're going to do when we're trying to secure these investments and do it, but it's necessary, and it can be a real detriment to your mental health as you're trying to jump through the demands of a bank. And so if we have the advantage of the debt within the DST structure, it's non-recourse, it's prearranged, we know who the lenders are, we know what the assets are, how they're tied to it, and everybody's happy. That is a serious gain for the investor who's not looking for any extra problems or any extra issues to have to resolve.
Yeah, and at minimum, it's something to at least be aware of, right? As an alternative strategy that can be utilized amongst all the other strategies that are available. Going back to this investor that I was talking about earlier, they refinanced a bunch of money out of the property several years ago. They have 30% equity coming out, 70% debt. The reality with anyone or a lot of people that are in exchanges at a higher exit loan to value is those capital gains are not taxed on just the equity. They're taxed on the total sale, right? So if you're at a 30%, 70% loan to value or 30% equity, and you have a 30% tax liability, on the 1031 exchange, if it's not completed, it wipes out 100% of your equity, right? So then it becomes, okay, can I go and qualify for a loan on my own and buy another property that I want to self-manage? Do I buy into a DST? Is it a traditional DST? Is it a zero coupon? Is it some combination of the two? I guess the message that I'm trying to get out there is be aware that these strategies exist because the 45 days comes and goes very, very quickly. Absolutely. 45 days is not a lot of time, especially in a traditional real estate acquisition cycle. So at minimum, the zero coupon strategy and just DSTs in general could really be a saving grace.
Absolutely. No, I think that's a great point. So good point.
Yeah. Well, I think we'll maybe just go ahead and close it down from here. But as I mentioned at the onset of the conversation, the zero coupon is a more complex structure. There is more risk involved. There's more nuance involved. So really want to encourage all of the listeners, please do connect with your K Properties representative. We really want to figure out, does this strategy make sense?
That's right.
And if it does, in what capacity, right?
Yeah.
Because this is not the right solution for everyone. It is something we have available as an option. But for certain investors, it could be a saving grace in their 1031 exchange.
No, that's absolutely right. And we're able to run the numbers on whether incorporating a zero and how much you're going to incorporate makes sense for you. And sometimes once you've seen a couple different portfolios and you have an idea of, okay, this is how it's going to handle the debt and this is what it's going to result in, that visualization really helps. And that's what we're here to do. We're here to help out. And so, yeah, if there's a question, please reach out your K advisor. We want to get on the phone with you. We want to talk to you. We want to Zoom with you and see what's going on and see if this is something that could help you out. Absolutely.
And last parting words, if you haven't interacted with our website, please go to kpi1031.com. We have a ton of great educational resources. We have other recordings on the zero coupon structure and many other topics. Also, you can log into our marketplace and view the actual live offerings to see what DSTs are currently available, how they're structured, what they look like. So with that, thank you everyone for tuning in. We hope you found this conversation helpful. And thank you, Tim, for everything you brought to the conversation.
Yeah, thanks for having me, Matt.
Visit us at www.1031.com for instant free access to exclusive investor resources, including our DST 1031 Exchange Book and the first ever 721 Up REIT book, written by our CEO and founder, Dwight K. You'll also find our Delaware Statutory Trust catalog and investor case studies. The K Properties team has helped over 4,000 investors nationwide, and we're here to help guide you every step of the way. If you'd like to connect with us directly, give us a call at 855-899-4597.